We amended the mandate to include international stocks because we think the Australian market is fairly valued at this point in time. We think the Australian market is fairly concentrated, which basically means that the structural reason for being overvalued will persist. And during these times, we think investors should have the ability to buy international stocks, which will provide a better risk reward. We think the real reason why the value is hard to find in the Australian market is because it's so concentrated. Out of the ASX 200, the top 20 stocks represent 62% of the market, which basically means the majority of the passive investors have to invest in these stocks, which pushes up the value of these stocks. So therefore, it's very hard to find liquid, good quality businesses in Australia that we think provide a good risk return reward. We don't think it's appropriate that Australian investors have such a high focus on dividends and franking credits. Franking credits and dividends are great, but if focusing on that, you miss out on capital growth. Therefore, we think investors should look at a total return rather than just dividend returns. We think 2015 is going to be a fairly volatile year. We think in 2015, the number of central banks around the world are going to undertake actions. For example, the US Federal Reserve undertaking interest rate rises, the ECB undertaking quantitative easing. What this would mean is that passive investors who invest in the market as a whole are likely to face volatile returns. Therefore, we believe this market is suitable for stock pickers who will pick individual stocks based on their fundamentals rather than macro events. One of the international positions that we bought is Intercontinental Exchange. Intercontinental Exchange is a derivatives exchange, one of the largest exchanges in the world, where energy, commodities and interest rates are the biggest trading products. What we like about this business is that it's a vertically integrated business which has a near monopoly position in all the products that are traded on it. What that means is it has pricing power. Secondly, what we like about this is that we're seeing a cyclical low in terms of trading activity around the world. Falling oil prices, low interest rate environment has meant that we're at a historical low in trading volumes. When these volumes picks up over the next 2-3 years, we expect 20 to 30% growth in terms of their revenues, and because of the scale, we expect earnings to increase by much higher than that. Therefore, this is a business that we really like. The second business that we invested in is Heineken. Heineken is one of the biggest beer companies in the world, which many people would know about. What people don't know is that over the last 10 years, beer market has been consolidating. A very fragmented market in 2000 is now becoming a highly concentrated market. Again, what this means is that the beer companies are having pricing power. So even though beer volumes might be going down or staying flat in majority of the markets around the world, beer prices are going up, which basically means that beer companies are becoming more and more profitable. And Heineken has been one of the consolidators around the world, and that's why we think it will do quite well over the next few years.